For more than a decade following the global financial crisis (GFC), we witnessed an extraordinary investment environment. The response of policymakers to the GFC saw interest rates hover close to zero in many developed economies, while central banks injected unprecedented liquidity into financial markets, quantitative easing. Meanwhile, inflation remained subdued, and equity markets enjoyed one of the longest bull markets in history. For many investors, particularly those who entered the markets after 2008, these conditions came to seem normal. They influenced everything from portfolio construction and company valuations to borrowing decisions and investor expectations. That state of affairs lasted until 2022 when the investment landscape changed dramatically. A surge in inflation forced central banks to raise interest rates at the fastest pace seen in decades. Bond yields climbed sharply and financing costs increased. In short, many of the assumptions that guided investment decisions for years no longer applied. While inflation has since moderated, few expect a return to the era of ultra-low interest rates. A new market regime is in place, one characterized by structurally higher interest rates, greater macroeconomic uncertainty, and increased market volatility. Interest rates influence the pricing of almost every financial asset. Higher borrowing costs reduce consumer spending and corporate investment. Mortgage repayments become more expensive and dampen housing markets. Businesses issuing debt or funding expansion face higher financing costs. For investors, higher interest rates increase the discount rate applied to future earnings, reducing the present value of many assets. Elevated rates affect companies whose valuations depend heavily on earnings expected far into the future, notably high-growth technology companies. There are rare exceptions. Sectors such as financial services may benefit from higher interest margins, although slower economic growth can offset some of these advantages. The new higher rate regime has brought a boost to fixed income investments. In the low interest rate era, investors held bonds primarily for diversification rather than generation of returns. Today, investors are reconsidering portfolio allocations between equities, bonds, and cash, as higher bond yields allow bonds once again to provide meaningful income while continuing to offer diversification benefits during periods of economic weakness. And portfolio construction is also being influenced by several other factors. Higher cash returns are reducing the opportunity cost of holding liquidity. Equity selection is becoming increasingly important. During periods of exceptionally low interest rates, investors often placed greater emphasis on long-term growth prospects than on current profitability. In a higher rate environment, investors tend to scrutinize cash flows, profitability, and balance sheet strength more closely. Businesses with excessive leverage, weak cash generation, or uncertain business models may find it more difficult to attract investment. Alternative investments, including infrastructure, private credit, and private equity, continue to attract capital, although higher interest rates also affect their valuations and financing structures. Rather than relying on rising markets to generate returns, investors are focusing more carefully on diversification, risk management, and security selection. In addition to higher rates, the new market regime has several other factors to consider that make investing a more challenging occupation. Financial markets in the years following the GFC were relatively subdued in terms of volatility. Today's environment is very different. Inflation remains uncertain. Geopolitical tensions continue to affect energy markets, supply chains, and trade relationships. Governments carry significantly higher levels of public debt than before the pandemic. Technological disruption continues to reshape industries at an accelerating pace. At the same time, central banks face the difficult task of balancing inflation control with economic growth and financial stability. The outcome of these interacting forces is an environment in which markets will respond much more sharply to economic data, policy announcements, and geopolitical developments. An entirely new proposition for many of today's investors.